All right, everyone, welcome back to another weekly roundup edition of On the Margin. Today, I'm joined as always by my magnificent co-host, Mr. Mark
Ha!
Bisla. Mark,
I
welcome
don't know
back.
if I can live up to that one, Michael. But I will. I will do the quick sock reveal. I don't know. I don't think we're going to talk much about macro. About crypto today. We might. So I have the Bitcoin wizard join us magic internet money socks on. I got the Bitcoin orange pants on for Bitcoin Friday. But it's like the least interesting story of all the macro stories this week. I mean, we got to go into the metaverse and talk about Meta and the craziness around that. We got to talk about, J-Pow, who, it's so funny. He thinks he's Jerome, clearly thinks he's Jerome. The market is like, no. J, the letter J, the pusher is back. I mean, it's insane. I mean, I don't know.
Yeah.
Animal spirits, baby.
So this was a big week of economic releases, and maybe the most important of which it wasn't necessarily a release, but we had the FOMC on Wednesday. And for those of you who listened to the interview portion of this week, we did a nice kind of in-depth breakdown with Jim Bianco and Jack Farley. So, but Mark, I want to get your opinion here. So we had, just to give the cursory sort of overview and summary, we got the 25 basis points that we were expecting. Jay, sort of continually again referenced this 3-month-old metric, right, which is core excluding housing services, right, which they're trying to, which, to their credit, they're trying to see through the noise and some of the more volatile, bumpy measures of CPI, and they're trying to get a sense of how sticky this is. And so they're excluding housing services as well, which is that lagging component, which is going to sort of plague CPI. Mark, what did you think?
It's comical. It's like, I say this all the time that, sitting down, I'm 6'3", but when I stand up, I'm just under 6 foot because I have no legs. So X legs being short, I'm a really tall guy. It's just such nonsense. First it was X food and energy. And I was like, oh, geez, well, this shelter piece is kind of volatile now. It's not supposed to be volatile. We kind of engineered it to not be volatile over the last 20 years by turning it into owner's equivalent rent. Well, then rent spiked. So the manipulation of the data to fit a narrative is reaching torturous levels. So, but people believe narratives. I mean, that's the thing that I just don't understand. Right? There's all this data in front of people that they can look at, and they could form a conclusion. But instead, they just listen to the man behind the curtain, right? Saying, "Oh, ignore the man behind the curtain. Hey, that person you see who isn't really the great Oz." I don't know. I'm frustrated by the way people listen to drivel and don't actually look at the data. It's crazy.
Yeah. So, I think the reason why this, why this surprised so many people is this presser that Jay just gave, Jay, not Jerome, was in stark contrast to the very hawkish, Jerome Powell that we've seen, even going back to his Jackson Hole speech, which was very much, we're staying here until the job is done. This felt much more market, right? There, he used this phrase disinflation, and he still, he did emphasize that, it would be premature to, relax monetary conditions too much. And he warned against, he again referenced this 1970s, 1980 period of Volcker, right? Where there's a danger in easing too soon. So he did emphasize that, but we didn't get this hawkish, stick it to the markets, devil may care Jerome that we've been seeing thus far. So, Mark, did you also have sort of a dovish interpretation of this particular presser? And if so, why? Because, we saw, as soon as Jay, when Jay was still speaking, the NASDAQ immediately jumped 2%. Bitcoin and the entire rest of crypto soon followed, right? And, since then, we've sort of started to see, I mean, it's like the meme stocks all over, right? You've got, so crypto and the NASDAQ are up, but you've also got, Carvana making a comeback, and it's led some, Jim was talking this week about, guys, this is, we don't want to run the 2021 playbook all over again. So did you have a similar interpretation there, or what were your thoughts on?
I actually hashtagged it, the McFly markets, Marty McFly from Back to the Future.
Mm.
So we are right back to the idiocy of, and I really mean idiocy. I mean, it is idiotic, completely idiotic, to say that because interest rates are increasing less quickly, that somehow that means there's this wave of liquidity to push up stocks. That said, when everyone's on one side of the boat, when everybody's short, and literally everybody was short, like all the hedge funds, all the institutions, all the banks, everyone was short. Rightfully so. I mean, you mentioned Carvana's making a comeback. No, they're not. Carvana's going away. Carvana, you've seen the pictures, right, of the empty car vending machines, and they're not coming back. They will go bankrupt. Their equity will be extinguished. But boy, in the short term, what's it up 350% in 5 weeks? So people are like, I told you, Yusko, that's a great stock. Like, no, that is a lottery ticket that the expected value of every lottery ticket is zero, right? Except one. I mean, one has some value, but the expected value, I guess it's not technically zero. I guess it's 0.0000001 cent or whatever it is. But the average person, makes their contribution to the lottery and, gets their 5 minutes of entertainment. And I don't understand it, but tax on the poor. Although I know some really rich people who waste their money too. But I think, generically, it's a tax on the poor. But I'm really struggling because, like Jim, I'm a value guy, and I actually like to run analysis of cash flow and earnings. But these companies don't have that, and they're soaring on hopium, literally hopium, that there's going to be some increase in Fed liquidity. Now, look, it is true that financial conditions since October have gone straight up, right? There's been a massive unleashing of global liquidity, first by the Chinese, then by crazy Kuroda-san, who, I mean, it's just amazing. Okay?
Yeah.
Kuroda did more QE in 4 days a couple weeks ago than all of the Fed's QT in 2022. So, I get it that, the don't fight the Fed. Well, now it's don't fight the global central bankers because it's more than the Fed. But the Fed has not done any easing. And here's the part that's really hard for me is stocks are supposed to be a discounted stream of future cash flows, right? That's the value of the equity of a business. That means there should be cash flow. And in a lot of these businesses, there aren't, 40% or 40+% of Russell 2000 stocks might have negative cash flow. They have no earnings. They're losing money. And so, I don't know. I'm struggling.
Yeah. It's hard for me too. And, on the one hand, I've sort of got two voices in my head, which is, a lot of people probably saw that chart of bond performance going all the way back to, the Revolutionary War in the US from Bank of America. And, you saw that 2022 was the worst year for bonds, basically in the history of the United States. And what you also saw in that chart.
Just let that sink in. Right?
Yeah. It's horrible.
Like the word ever, whenever we can use the word ever or in the history of the United States, not that the United States is really old, but we're kind of old. 247 years now. It's a long time.
It's a long period of time. I don't know how they normalize that data, but that's a feat that they put that together. But if you looked at the year after there were these big drawdowns, what did you have? You had mean reversion. So look, last year was a terrible year. Even if there's more pain ahead, you would expect some degree of reversion to the mean, even if it's just mechanics and shorts getting squeezed or whatever it is. One thing that I'd like to call attention to and get your perspective on is we know that the Fed has been paying a lot of attention to wages, right? So before we had the FOMC on Wednesday, we had the economic cost index. That data went live, I believe, on Tuesday. So that showed that wages were slowing. So that, there's basically what Powell has, I think, in his head is this idea that if people are getting wage increases right at 5%, if the wages are growing at 5%, then they can actually support the cost of 5% inflation. That's why there's such a laser focus from the Federal Reserve on wage pricing power and the unemployment rate. And both of those things, the unemployment rate has stayed pretty stubbornly at these historic lows, but you are starting to see wages, pricing power of employees kind of turn over. So I would love to get your thought first, Mark, at a high level of, do you agree with what the Fed obviously believes, which is we need to see some slackening in the labor market to ultimately tame inflation? And then B, are we seeing that slackening, or do you think we'll see it soon?
Yeah, look, you know how I feel about this, that I don't think the Fed has anything to do with what we call inflation. Mm-hmm. It's oil prices and used car prices that were triggered by the base effects of shutting an economy down, then turning it back on. And look, CPI perfectly correlated 16 months after M2 growth. M2 growth went negative for the first time in, I think, 96 years. Let that one sink in. It's been 96 years of constant money printing since the Fed was created, to diminish the value of the currency, to steal wealth from the masses and give it to the people at the top, which, right, income and wealth inequality is where it is. So mission accomplished by the Fed. But the challenge now is, again, I don't know, all of this is literally nonsense, in that there is no pricing power for employees. How many announcements of 10,000 workers being laid off have you heard in the past month? Every single day, another company is laying people off. Our company, for the first time in 20 years, we had to let some people go. It's just never, we never got to that point before. Mm-hmm. This has been, and this idea that, unemployment rate is so low. Well, no, it's not. It's because you're fudging the numbers. Again, the massive engineering, right, by taking people out of the labor force, making the labor force seem smaller, so the percentage of unemployed, those people are still working. But just because they turn 65 doesn't make them out of the work. That's the way they do it. And the birth-death ratio nonsense. So I hear the narrative that people have crafted, and I hear the torturing of the data, right? If you torture the data long enough, it will confess. The torturing of the data continues, but you go around and you look at economic activity, which is the true measure of whether wages are good or not good, or economic activity, it's not so good. In fact, some of it is downright abysmal, like plumbing levels we haven't seen since global financial crisis or the Great Recession or the period, the tech wreck. I heard somebody say, "Oh, this is just like March 2009." Like, in what way is this like March 2009? I mean, other than the fact that you've had a short squeeze of the crappiest stocks, but in 2009 you actually had a Fed that was printing money at a rate we hadn't seen in decades. They were buying bonds. They were not, trying to shrink their balance sheet. So to say this is like 2009, just silly. And I was going to say maybe I was early, euphemism for wrong, in that I thought last year looked exactly like 2001 to me. Exactly. Tech bubble correcting, the fraud bubbles to the top, the market goes down. But maybe it was 2002, and maybe now this is March 2003, Well, no. Well, we don't have an invasion of foreign country to boost GDP because that's what we do when GDP gets really bad. I don't know. We'll see. We'll see. I think first quarter GDP bad, negative, and then the narrative will shift again. But we'll see.
What's going on, guys? Want to give a quick shout out to this episode's sponsor, Curve. They are the one-stop shop credit cards that helps you take control of your personal finances. Here's the reason that I personally love this company. These guys are all about helping you manage and maximize your personal cash flow. We have been talking for the last couple months about everything that the Fed is doing with raising interest rates. Obviously, no one's got a crystal ball. This is not financial advice, but I think it makes sense more than ever now for companies to be managing their cash flow and for you as an individual to be managing your personal cash flow as well. Curve makes it super, super easy to do that. Even I can do it as a technological Philistine. They aggregate all of your spending information in one place. They make it super easy to plan. But they actually go one step further than that. They have a very cool feature called Go Back in Time, which allows you to switch payments from one card to another. So if you have an unexpected expense crop up, boom, you can move that over to your credit card, free up some cash. Or maybe you learned too late that you could have earned more rewards by spending on a different card. Boom, Curve has you covered there too. And the last thing that I'll say is, if you click the link at the bottom of this episode, you'll get $20 in Curve cash, but you'll only get that if you click the vanity link at the bottom of this episode. Plus, that gives me the credit as well. So thank you, Curve. I appreciate you caring about cash flow. Guys, click the link at the bottom of this episode. Tell them I sent you. It's funny. It's like if you look at the projections that, the consensus economists projection for GDP, they have it, bottoming in, Q2 of Q3 next year. So they actually have it going negative, I think in Q2 or Q3. And then it kind of is this smile curve. It's like the Masayoshi-san deck, if you ever saw the EBITDA recovery, which, you know what, actually, if I could go, he gets a lot of crap for that. I actually just think he was just being much more honest than most are because of his position. Mark, as a VC, how many charts have you seen in your, how many charts have you been pitched in your life? What is the general direction that all the revenue goes? It's all up and to the right.
Up and to the right. No,
I actually thought it was
not one.
Yeah.
Not one ever. I call it the spreadsheetization of America.
Yeah.
Right. Since I graduated from business school, 1987, my first week on the job was, the crash. That was fun. Since I graduated from business school and Lotus 1, 2, 3 was released. Okay. So it went away from, now I can't even remember the name of the, VisiCalc and went to Lotus 1, 2, 3. And most people are like, what's Lotus 1, 2, 3? Excel. Since then, not once have I ever, and I mean ever, and I've seen a lot of pitches and I've seen a lot of analysis of companies. Every single one goes up and to the right. Every single one. There's never even a scenario like base case, worst case. They all go up and to the right because that's what the function in, these spreadsheet packages does. Yeah. And there's another thing about the spreadsheets that really bugs me is the IRR function actually doesn't use interest rates. It integrates its own number, the IRR number, back into itself. So it's like double counting. So you get these incredible IRR numbers whenever you put stuff, and everybody's like, oh yeah, this project's going to be a banger. And then when things don't go as well, they're like, what happened? Like, well, because life, we've all seen the picture of, what people think life is and what life is, right? There's the crocodiles and the bicycle and the hill and the boulder, and you fall down a couple times. Maybe you can get there, but it is not up and to the right, which is every presentation I've ever seen. The worst. No, I want to share this. So I will keep the company nameless. A company that pitched us, and they said, okay, in 2022, we're going to have $800 million of revenue from zero. In 2000, I guess the pitch was in 2018. So in 4 years, we're going to go from zero to 800 million in revenues.
Pretty damn good.
Yeah, pretty damn good.
It must be worth a lot of money.
So turns out last year's revenues were $22 million. And they did a call. And I actually want to meet, because I don't know who it was, but because I couldn't see him. But someone actually asked the CEO on the phone, on the call. So I'm looking at the pitch from 2018, and we were supposed to have 800, and we're at 20, and you're in this all positive mood. And he said, well, we've revised some things. And I'm like, wow, yeah, we've revised some things.
Yeah.
So,
revising things is what you do when you're 95% below where you expect it to be. So,
right. That's the difference between an investor and a trader. An investor is a trader who's down, right? Because it went against you, and now I'm an investor, right?
That's really good. All right, so let me just get, because I want to move on to there's stuff happening over in the EU as well. Actually, before we get there, I want to talk about the liquidity picture, but let me give you my sort of thoughts here. Trying to synthesize everything that I saw from Jay, I think that he believes he's getting his soft landing. That was my conclusion from listening to him, right? So soft landing, I forget. There's been like two, right? In the history of at least the last like 100 or so years. One of them was in the 90s under Greenspan, and I think that's what he sees. And you know what? I have to admit, there's the part of my brain which is, we added record amount, huge amounts of liquidity. We had animal spirits like we haven't seen in since the .com bubble or probably even before that. We had the greatest withdrawal of that liquidity, again, ever. We keep setting records on every chart that we post. And it would make sense to me that, even to revert to the mean, right, it would need to go further than it has. At the same time, like every sign of economic strain, that might be suggesting that there's going to be more pain ahead has not materialized, right? The, balance sheets of American homes, we've gone over. They're actually extremely healthy. Credit spreads have remained tight. Stock market has corrected within a sort of a healthy range. I don't know. At what point do you say, look, you don't want to be changing your mind here at the time, but when the data changes, like, do we change our mind now to maybe caveat that just because this is a soft, someone made a really good analogy that in the 1970s, which by the way was not a particularly fun period of time, so I'm told, to live through from an economic standpoint, there were multiple soft landings, right? Because you had multiple tightening cycles that Volcker put the economy through. So again, this could be part of a longer stop-start inflationary thing, but the data, at least, as it looks today, points to something that looks like a softer landing. I got to be honest, I'm kind of throwing my hands up and feeling confused here.
Look, from 1968 to 1982, the economy went precisely nowhere. We had multiple recessions, multiple recoveries, and quote unquote these soft landings. Because I guess if you fall from a really low level, it's softer than if you fall from a really high level. So the fact is, you never took off, you didn't crash. So I guess that's one way to look at it. But from 68 to 82, the stock market was precisely 1,000 points. The Dow Jones Industrial Average was 1,000 points for 14 years. And yes, it went up and went down, and there were big drawdowns and big recoveries. And there's another bull market. Dead flat for 14 years. So, yeah, great. That's where I think we probably are. I think we're going to have a lost couple decades of basically no economic growth, kind of like Japan's had for the last 3 decades. Stock market probably does this, right? I made the bet with Kevin O'Leary on CNBC 4 years ago that Amazon would be dead money for a decade, and so far I'm winning. And I don't. Again, I'm not gloating in the fact it's not that Amazon's not a good company; it's a great company, but they just reported the largest loss in their history today, right? I mean, this is today we're recording, but tomorrow you'll listen to this. But today is going to be not such a fun day. We had 4 of the largest tech stalwarts, all of them. I don't know, don't want to say shit the bed, but okay, shit the bed. I mean, it was bad. It was bad. Apple was bad. Amazon was bad. Shoot, I can't remember the other two, but all four of them bad. And on top of that, that's on top of Microsoft was bad. Netflix was bad. Even Meta was bad, right? They missed on revenue. The revenue growth is turning down. Apple's, which just went negative. So those are not growth companies. But everybody spins a narrative. So Netflix spun the narrative of, oh, look, we added so many new subscribers. Yay, us. Okay, there's this young guy. Now I wish I could give him a shout out, but now I can't remember his name. And I love him. I started following him on Twitter. And he said, in the past 12 months, Netflix spent $2.8 billion with a B on advertising. Okay. Divide that by the number of subscribers they got. It's $284 per subscriber. He says, here, let's make a deal. Send me a check for $284 and I promise I will sign up for Netflix and then cancel after 3 months. I mean, because that's what's happening, right? You give someone a free for 3 months and then they're a subscriber. You pay $284 for that. And then they cancel because their mortgage just went up by $1,000. This is the part that no one seems to be talking about. Mortgage payments are going to go up $1,000 on average this year. Okay. The average family does not have $1,000 after tax a month. Not a whole, like they don't have $500 for an emergency. They don't have $1,000 a month. They're going to cut. People say, oh, they'll never cut Netflix. You watch what they cut. Quick service restaurants going to get destroyed. Home builder stocks are back to record highs, despite the fact that new permits and house sales and nonsense. So, and then Meta was the other one. Meta went up $100 billion yesterday.
Well, so let's talk about Meta for a second, because that was a big one.
Two Twitters. That's two Twitters.
Yeah.
In one day. So
Meta, the reason for it's it's not some crazy it's not some crazy thing. So I actually thought they I'm trying to load you. I thought they'd beat on earnings. They had some $32 billion or something in revenue, but they were right around, right? It was it wasn't spectacular on the earnings front. What moved their stock price was, first of all, there was positive commentary and guidance from Zuck, right? Which stands in pretty stark contrast to their third quarter earnings, which was disastrous, right? And their stock, plummeted like a bowling ball in a lake or whatever. But the other thing is that he talked about increasing the shareholder buyback program, which
right.
if you want to make Wall Street, I mean, what Facebook was coming under fire, or Meta was coming under fire for, criticism for, was the amount that they were spending on their Reality Labs unit, right? And that was their play on the metaverse. And what investors want to see. I mean, tell me if I'm reading into this too much, but it is interesting. So I guess first of all, Apple was the one who really turned the tides here, and they started like with a really aggressive stock buyback program, and that's what got Warren Buffett interested in the stock. And Facebook has been doing a pretty good job of they've been buying back an enormous amount of their stock as well. To me, when I think about the life cycle of a company, and I hear that a company is buying back a lot of their shares, they're returning capital to their investors. That signals to me a more mature company. And the life cycle of a company is you start out as a very high growth sort of company where you get valued on your 30% quarter over quarter growth or year over year growth. And eventually what investors want to see is that translate into cash flow and dividends and returning capital to shareholders. And it seems like what Wall Street is saying to tech is, we know you guys have been growing for a long period of time. We gave you a huge amount of rope. Nobody cared about seeing many profits for a long period of time. Now we want to see some profits. And there were some quotes from analysts here. there's an Evercore analyst, Mark Mahaney. There's a quote: "Does Meta really deserve to be up 20% in the aftermarket?" In a word, yes. He cited materially reduced expense projections, larger than anticipated share buybacks, and he upped his price target to $275. And it was like a slew of analysts, analysts that were changing their tune on Meta. So, I mean, I don't know. To me, this kind of slots into the bigger narrative of these tech giants, these blue chip sort of FANG tech stocks transitioning from investors demanding growth at all costs to we want capital returned to our pockets, which has been going on for a period of time, but that's what it looks like to me.
It's
what
just
do you think?
fake. It's like fake meat, right? You can believe that somehow it's meat, but it's not. You shouldn't put it in your body, and you shouldn't buy these things. I mean, it is. I will say one thing: Meta at $88 or $86 or whatever it got down to. Okay, it was too cheap. But this is, what happens in short squeezes when narrative gets bought. And the growth potential of these businesses is gone. And you say they're the mature company, and I love the order that you put it in, that Apple decided to buy back shares and then Buffett got interested. No. Buffett said, here's how it goes. Your stock is suffering. I'm going to buy some, and you are going to do a couple things. You're going to promise to give me, okay, who will become your new largest shareholder, share buybacks. Okay. In exchange, I will get you a tax cut, which is exactly what he did. He got the corporate tax cut for these, tech companies that didn't deserve it. And that's how the game is played.
How did he get the tax cut?
Money. He paid the politicians to pass it. And the game was, we'll give you a tax cut, but you have to then take that money and not spend it on innovation and new businesses and growth. You got to give it back to us rich guys. Just look at when the buyback started, go back to the tax cut, look at the people who are doing the biggest buybacks, and look at where the money's coming from. It was a direct government transfer from the government, where those taxes used to be going, into the hands of management and Warren Buffett. And that's the way it's always worked. Think about when he did the same thing with Wells Fargo years ago. He said, all right, I'm going to buy this crappy little bank that, cheats and does all kinds of bad things. And now we know how many bad things they do. But they charge fees instead of NIM. They're not like a JP Morgan where it's big on the net interest margin. They charge these fees, like overdraft fees. Now, the fact that they engineer poor people's deposits and withdrawals to maximize their fees. This is crazy stuff. Like you got $100 in your bank account and you got a rent check for $200 and your income for $150. They process the rent check before they process the deposit, charge you an overdraft fee. Even though you were good and you actually wrote the checks in the right order, the software cheats you. And that's billions and billions of dollars. So that money goes directly from the poor people to the rich people like Warren. So, I mean, that's the one. Money talks, and that's how bills get passed. And the idea that we haven't even talked about the crappy companies. At least the big FANG man stocks are good companies with good, mostly good products. I'm not a big fan of social media, but Apple makes good products, and Amazon is a good company, and Nvidia makes good chips. Microsoft, good tools. So good companies, but their growth rates are low single digits to now negative. They do not command 20, 25, 30. I think Amazon's at 100 times earnings again. That's insane. And no matter how many shares you buy back, you can't make it work. long term. In the short run, knock yourselves out. People will believe it. Shorts will get slaughtered. And I don't know. Maybe I'm
Mm.
just a sour old man who can't, grow out of my value investor ways, but I don't get it.
Well, I mean, I think the thing that would make me look, this is my mental framework for how things should probably go. After you have a year like 2020, 2021, even beginning of 2022, there's a shoe to drop, right? Like I don't look at what happened in 2021 as like, oh well, look at this phenomenal economic growth and this amazing engine that we built in the United States. Like, no, that was, an enormous amount of liquidity that was injected by the Fed, and that was stimulus, and that's the reason why that sort of mania happened. Which, look, I know they bridged what was a very difficult time, right, with COVID and all that uncertainty, but honestly, it wasted a lot of people's time as well. I mean, a lot of money went to the wrong things, and now we have to undo some of that work. And look, if you work in crypto like Blockworks and Morgan Creek, right? It's been a tough 2022. If you
Mhm.
work in like the craziest of the growth tech stocks, it's been a relatively tough year. But again, I know you just referenced these 10,000 person layoffs. You know, we're not even none of these companies that have done these layoffs, these 10,000 person layoffs, they're not even back to 2021 numbers, right? So there
Yeah.
just hasn't been quite enough, as much pain as I would have thought. But who knows? I don't have a, I don't know. I could be wrong. Last thing I wanted to get your opinion on is, we've been talking a lot from the, if you've been paying attention to what moves prices in the last couple of years, we know that it's liquidity, right? I mean, that's the major mover of
Yep.
markets. So, the last thing that Powell said, and this is, I'll put my hand up and say I don't fully understand the mechanics of how this works, but he talked about the balance on the TGA, the Treasury General Account, draining. And for those of you who are listening, that consider that's like the checking account, right, of the U.S. government. So
Mhm.
when the TGA goes down, it means that the U.S. is spending money; it's liquidity positive. So I'm sort of trying to balance that in my head, with that could be an explanation for why stocks are going up, right? The U.S. government is spending money. At the same time, we have a bunch of liquidity that's still stuck in this reverse repo facility, right? Which is, it's not liquidity positive or negative if it's staying still, but that's almost like that's still liquidity that could come back into the market. And at the same time, you've got the China reopening, which we haven't really talked about too much.
Yeah.
But I mean,
Yep.
the liquidity picture doesn't look quite as negative, as it did certainly last year, and I'm wondering if that's part of what stocks are sniffing out
Well,
too.
certainly, look, there's no question Q4, fourth quarter, massive government spending, big inventory build. And Powell did say, right, don't expect those two things to continue, right? So he was kind of warning that Q1 GDP is going to be not so great. But if you look at Q4, 75% of the growth, it wasn't really growth, was this draining of the TGA, government spending, and building up inventories. Now, look, we did talk about this a few weeks ago, saying that the amount of tax loss selling that occurred in 2022 did set the stage for the potential for this January effect. This now I didn't think it was going to be this crazy, where you had stocks going up 30% every day, and companies like Bed Bath and Beyond, I mean, bankrupt, like liquidating, gonna go away, and people are still punting in that stock. So good for them. Musical chairs, it's not a game I like to play, but here's the thing that I just don't understand is the Fed is not adding liquidity. They're just not, right? They're simply not. The ECB, not. See, the ECB is now in the hot seat. Ms. Christina, she's got a problem. She is now the one that has to raise. She's 200 basis points behind everybody else. And that's going to be a tough one for Europe. Now, the European banks love it, and the European banks are going, bananas. But rest of Europe isn't going to like that very much, particularly the exporters. because it's going to strengthen the euro, and dollars continue to fall, euro is going to strengthen. The yen is the wild card. I mean, Krotosan unleashing this Kroto tsunami, that should actually weaken the yen pretty badly, which maybe the dollar stays flattish. But the euro probably going to rise a lot, and it's going to be tough to sell, Volkswagens and Audis if your currency's strengthening. So I think Europe's going to struggle from an economic growth perspective. In fact, I think Germany just went negative in Q4, like 0.2 or something like that. So economically, I get why Jay Powell is saying, don't count on the government spending to continue, because we're almost out of money, and they're certainly not going to increase taxes, because that's not a popular platform to run on. But I still come back to PMIs are rolling over, industrial production is rolling over, new orders component of PMIs are rolling over. I don't see any catalyst for a strong recovery. And if the definition of soft landing is the Chuck Yeager, right? Any crash you can walk away from is a good landing. Okay, well, we're not going to crash, but I don't see us getting back in the sky anytime soon.
What would you see that could make you change your mind on this? Like, what is there a bit of economic data that you could see that would make you say, hey, actually things are better than I initially thought?
Let's say PMIs stop going down. They don't even have to go up, just stop going down. The forward prices component, retail sales stop going down. We just had the worst retail sales number. I don't think it's in history, but it was maybe 30 years, 40 years. I mean, it was a long time, minus 1.5%. And that's with no adjustments for population growth. So it's worse than that. So retail sales stop going down. That would be a positive for me. I'd like to see industrial production not going down, like not negative. So I'll take any of those. I mean, 3 out of the 4 big 4 are negative and saying we're in recession. The only one that's keeping us out of recession is the employment number, which I think is totally cooked. So I don't know. If GDP in Q1 isn't negative, I guess I'd have to say that I'm wrong. But I look at earnings this season. Earnings has not been good, right? It just hasn't. And yet the multiples expanded a lot. That doesn't make sense to me. Multiples should not expand in rising interest rate environments, full stop, right? Because the discount rate at which you're discounting future cash flows is still rising, right? Interest rates just went up 2 days ago. They didn't go down. And yes, the forward curve is pricing in cuts this year. That's I think the craziness of all of this is all of this rally, not all of it, a big chunk of it is based on this idea that the forward futures curve is right, and that Powell's jawboning is wrong, that he's not as Jerome-y as he wants you to believe, that he really is J-A-Y, or worse, J, the pusher. But I think we got 50 or 75 basis points of cuts priced into the forward curve, which I'll take the under on that.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. they can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank me later. Yeah, we showed a chart on this Wednesday's episode, which is basically what the Fed says they're going to do in terms of where they're going to get to in rates and what the market is pricing in.
Yeah,
and
that's
what
what I'm
you see,
talking about.
yeah, exactly. And you see that there's a big divergence that gets more pronounced throughout the rest of the year, where you see the market is pricing in the first 25 basis point cut by, I think, September or October. Mm-hmm. So, and usually, historically, the Fed has come when there's that divergence, the Fed comes to the market instead of the other way around, with the big exception obviously being 2022, right? Where the bond market said there weren't going to be any hikes. And obviously the bond market was wildly wrong and incorrect. Yeah. So, history is only a guide. And one thing that I'll say about finance that maybe this is still a little bit of a beginner's mind or whatever, but, you often hear these pronouncements that people make, which is, here's one that we hear a lot. The Fed has never, and this comes from Stan Druckenmiller, who's the GOAT, right? So I'm not taking a shot at Stan here, but the Fed has never cured CPI without getting the Fed funds rate above CPI.
Yep.
That is referring to 2 data points in history, right? So like very often you'll hear these pronouncements refer, when you learn statistics in school, the very first thing you hear is like correlation doesn't equal causation.
Yep.
And an enormous amount of finance and these like scary pronouncements that you hear are exactly that, is correlation that's, equating to causation. And you're using it on like 3 data points. So I just want to caveat that all by saying like, that's what always gives me a little humility. And like, so I've been convinced at various points that this is what has to happen. You hear these sort of pronouncements, but just keep in mind, we're working from a very limited data set here when it comes to finance.
Yeah, I think that's an incredibly important point and an incredibly wise, wise beyond your years, an incredibly wise perspective. I really, I really, really do. And I think that is true, right? There's a lot of stuff that gets pronounced based on very little observed trend. The problem that worries me is we have a whole generation of people right now, right? Through no fault. I'm not a blame. It's not like the old boomer guy talking about the young guys. We have a whole generation of people in the business that only know polluted data. And what I mean by that is if you go back before 2000, right? Yeah. If you go back before 2000, actually before 1995, if you go back before 1995, for 100 years, right? We had a very cyclical, predictable set of cycles around the business cycle, the liquidity cycle, profit cycle, valuation cycles, and all the measures were mean reverting, they were normal, they followed very good statistical models. And then with irrational exuberance and Alan Greenspan, we entered the central banking era. And since Greenspan, we've been in a period of polluted data where all of the traditional relationships broke down, whether it's GDP to market cap, market cap to GDP. I mean, if you think about it, right? The market cap, the equity market cap of an economy should be less than its GDP, right? Because it costs money to make money, right? There is a cost of doing business. So, but that's not where we live today. We live in this rarefied air of like 130%. Doesn't make any sense. We look at price to sales, okay? Price to sales. 8%, it might be even be higher now, 8% of companies have price to sales of greater than 10. Not price earnings, price to sales. That number should be sub 1. In 2000, it got to 4, and that was crazy. Okay? So that makes no sense. And people say, oh, well, zero interest rates. Well, we don't have zero interest rates anymore, y'all. We have 5, 4.75. We have 5. So to say that we can have, I mean, Apple's EV to EBITDA is 5 times its normal.
Yeah.
Look at the long-term history. It's 5 times its normal. That's not normal. And so everybody says, oh, but it's cheap because it went down. No, it's not cheap. It's not even close to cheap. And based on its revenue growth, which is now negative, how much should you pay for a company with negative revenue growth? Not 30 times, not 25 times, not 15 times, not even a market multiple. And everybody's like, oh, but the market multiple in the last 20 years. Oh my God, are you kidding me? You can't look at a subset of polluted data and say that's normal. You just can't. But that's where we are. And all the models now only go back 20 years, and everybody's looking at it just, and it gets worse post 2009, right? The QE era made the pollution even more toxic. So now it's not just polluted, like it was polluted in the 2000 period, 2010 period, but now it's just toxic. I mean, like total garbage in, garbage out. But anyway.
I largely agree with that, but I don't know what the solution is. Like
I know.
I'm kind of with you on this. Like I'm also looking at it like you, right? I'm looking at debt to GDP. I know there's the Buffett indicator, right, which has been screaming that everything's been overvalued for 20 years.
Yeah.
But I also see this. You know what? Actually, I know he's not your favorite guy, but I did. Ben Hunt made an analogy about kind of the 3 body problem.
Let's correct that. I think Ben Hunt's perfectly fine guy. He didn't like me, but it's not like a mutual disadmiration society. I mean, I like him. He's a perfectly fine guy. I don't really know him very well, but he didn't like me. But that's okay.
So we'll have to get you both on the show and talk it out. But he made this analogy that did stick with me, which is like this idea of like have you ever heard the 3 body problem? The problem in physics where you got 2 balls orbiting in gravity. You can predict, right? You can turn the crank of this mechanism and you could say, okay, I know the mass and I know the velocity and I know the gravitational pull.
Yep.
In 1 hour, these balls rotating around, I know where this ball is going to be relative to that ball. When you introduce a third, something funny happens. You would think that because you know the mass and the velocity and the pull of gravity, you could do the same thing. You could pull your crank and you could tell where all these balls are going to be relative to each other in an hour, but you cannot. A third ball introduces this whole other gravitational field, and it's this big problem in physics, and it spawned a book called The Third Body Problem, which is a great book. But that's what central banks are. They have introduced this weird, gigantic variable that has disrupted, to your point, this very predictable cycle, the business cycle, the liquidity cycle. And you and I can sit here and be like, this is weird and this is wrong, but they exist, So
well, they certainly exist. And look, Santiago and I got in the debate, which again, not argument. I love Santiago.
Yeah.
And it's okay for us to differ. He thinks memes have value. I find that hilarious. I mean, absolutely hilarious. So what you're telling me is because I create a picture of a funny phrase and people then buy something related to that funny phrase, it has value? Where? What value did it create?
I actually I could steelman that argument, by the way. I know. And right. let me try to steelman the argument. The social media has won in terms of distribution. The best way to go viral on social media is to become a meme, right? Yeah. Like I actually saw there was a meme that was made about forward guidance, warmed my heart, which is awesome for Jack. But also I'm like, that's awesome because that means he has penetrated the mind virus and like, it's just growth. It's just distribution. It's just another growth.
I know. And look, I get it. Like every day I have to live with this where I say, the bear market in crypto will be over when Doge and Shiba go to 0. They never got to 0. In fact, they're going up again. And there's no there. And the only there, this is the crazy part, the only there is the people who say, well, you better watch out if they actually find a use case. I'm like, oh my God.
Who says that?
11 billion. Oh, so many people.
Really?
Many people.
You better watch out if they find that's super funny.
Better watch out if they find a use case, because then you're going to be wrong. I'm like, it's already valued at $11 billion for nothing.
Yeah.
Like literally people. And here's the crazy part, right? It's valued at $11 billion. Okay, but what's the value? What's the underlying value? Could you turn it into somebody to get something? Nope. Like, at least Amazon, in theory, other than today, they generate profits and cash flow. Again, not today, but in general, they have found a way to produce return by, they got away from the, hey, yeah, we lose money on every sale, but we make it up on volume, ha, ha, ha. They got away from that, and they actually had a period where AWS was actually generating some cash. Okay, so if I had a share of that company, I could give it back to the company, and I would actually get something for that. Now, I will argue that companies like Tesla, maybe it's a little less clear how much value there is there, but a meme stock or a meme coin?
Yeah.
No, there's no value. So all it is a collective delusion that, Michael, if you don't sell and I don't sell, then the price can't go down. So just everybody not sell. And in fact, if we can get some other people to buy, then the price will go up. That's Tupperware, right? That's God, what's the door-to-door thing in Grand Rapids? The multi-level marketing. Amway. That's Amway, right? As long as we can continue to get people, dog-pilled and they buy this, then we, who were in early, we can sell to them. Okay, but that ultimately has to end, and it should have ended with the elimination of free money, but it didn't. And so,
but the market doesn't believe the free money's gone. I think that's the rub. That's what I think is the case. I don't think that the market believes that.
Okay.
So here's my
Michael, very smart.
Yeah, that's what I think is happening. And my concern as an operator of a business, right, is like, look, Block, we've gone through some times, right? Like we made it through COVID. We made it through 2018 and 2019. We made it through this year. Man, and when you put it like that, there's actually been more bad times than good a lot.
I know. But it's been a lot of bad times since 2018.
But the one thing that we've never dealt with, and I know that history is replete with example, like 3-year periods of time. It's always these like short, extreme bursts, and it has given rise to this idea of like just so many people. There's so many even founders that I know. Whenever there's hard times, like, okay, this will last for like 6 or 9 months. And you tell me, like, did people always think that way? Or because I'm always like in the back of my head, I'm like, well, the dot-com bust, which I know is big, but still, that lasted for like 3 years, that you had to fill your coffers and be financially responsible. And, Block, we run things financially conservatively because I'm all in the back of my head. I'm always like, it could get bad for 3 years.
Yep.
That's what I always am thinking, but it doesn't seem to materialize.
No, it's the pollution. This isn't the pollution. If you go back in history and you look from 1776, beginning of the Republic to like 1913-ish, interestingly, cycles were very long, deep and high, boom, bust. But recessions happened a lot. Right? I mean, there were recessions and there were expansions and contractions, but they were cyclical. And like you said, a bad period could last multiple years.
Right.
Since 13, those cycles, the amplitude started shrinking. So not as big wins, not as downs, but also the frequency started to come in. So they started to happen faster. Well, now we're like at this frenetic kind of bouncing, not as high, not as low. Take the COVID dumbness. There's a dumb word. Stupidity. Take the COVID stupidity out. We're at this rapidly vibrating freak, and the frequency is so short because, to your point, social media is one, right? Social media doesn't allow cycles to last their full trend because everybody's, here we are. We every week we talk, and we're part of the issue in that. At least we're not doing it daily, but everybody's out there yammering, and it definitely has shrunk the
attention span,
the frequency.
I will actually say, I'm not a huge New Year's resolution guy, but I actually made one of my resolutions this year to limit, I think I told you this, my screen time to 3 hours a day, as if that's some, titanic effort. But I feel it too. Look, I got our newsletter writer, Byron, shout out Byron, gave me a book recommendation for The Power Broker. It's the story of Robert Moses, the famous New York City politician, the New Deal guy.
Yep.
And, I'm starting to read this thing, and every 2 pages, I'm like, got to check my phone. It's crazy. It's like it's an addiction.
Look, it's a totally addiction. First of all, it is an addiction, right? I mean, it is an addiction. And I've told the story, Pomp worked at Facebook, and he said on top of the whiteboards in the conference room, the word addiction was written because it is about addiction. And you just got to take cold showers. I just found out that cold showers are the new cocaine. I was like, what? They're like, I guess when you take a cold shower, which I didn't realize, I knew this happened, that when you turn off the water, there's this feeling where your body's like rewarming itself, but that's a dopamine hit. Just like, so if you need a dopamine hit, just take a cold shower. Don't look at your phone. But
Pump, sorry, I don't mean to interrupt you, but Pump wrote a great newsletter this week. I don't know if you saw this. It sums up everything that we're talking about, which is that the Fed, basically everyone's on easy mode. And, lower interest rates, what that does, the interest rate is there's a concept in finance called your cost of capital, right?
Yep.
And a lot of the time, because there's a lot of debt financing, that has to do with your interest rates and the amount that it costs to service your debt. If you lower that cost, it means the hurdle rate, the amount of economic surplus that you need to generate over your interest rate, gets easier and easier and easier, right? And what lower interest rates have done is it's trained my generation of people, me, this has impacted me on what they think life is like. I was talking about, I had a
it's the giant easy button.
Yeah,
it's the giant easy button. Just smash.
That's my concern is, I talked to a buddy of mine who actually works at TikTok, and he was describing the difference between US based engineers and Chinese based engineers. And he was like, It is a night and day difference. And I don't want to be one of these, I know that this kind of vibe is, people don't work hard enough, and that's not what I'm trying to get at, but it is. He was like the US engineers, they come in at 12. He's like, they work 3 or 4 hour days and they leave.
Michael, we've all seen the day in the life TikToks of the Google of Google engineers. We've all seen them. It's not imaginary, right?
Yeah.
And someone was saying, the good news is now we're going to have less, because Google laid off and somebody else, oh God, who was, anyway, they're like, now we're going to get more, whatever it was, puppy videos and less, day in the life. I'm having my matcha and going for my massage, and then I knock off at 4:30. Oh, I'm laid off. Yeah. And that, to your point, if you're laying off people who are working 4 or 5 hours a day, maybe net, maybe they shouldn't have hired that many people. Now they're laying off the rip. And Twitter, right? People are complaining Twitter. I still love Twitter. In theory, they laid off 80% of their staff. I don't know if that's true or not, but that's what all the reports are. Nothing changed. As far as I can tell, nothing changed. I mean, there's some new things, but nothing changed. How can you have 80% of your people and have nothing change unless
I'm actually
those
pretty
people
surprised about that too. I will say,
actually doing anything.
Yeah, I will say that, and then maybe we can end this on a positive and optimistic note. I think just to frame the context of this is like, my only concern as like a relatively young person is like, I want to make sure that my experience and my view of the world is not based on faulty data. I think that's that's the framing of this. And the positive note that I'll leave you is that same conversation with my friend who works at TikTok. He said there was still like the ingenuity actually that came out of there's an open-mindedness and approach to problem solving in the US that still is like unmatched. So there's like so much good here, so much reason to be optimistic. There's so much like hope. But again, I just want to make sure that I don't know, that we're is a lame way to end it. That we're capitalizing on that, I suppose.
Look, that's
the environment that I want to work in.
It's 100% the answer, which is we can't just be a society that just entertains each other, right? That's the bread and circuses of Rome, and that's what led to the fall. We need constant innovation. We need constant creativity. We need, and actually, right, to make lemonade when the world hands you lemons. You get laid off. Now you got to go do something. And a lot of great businesses are going to be created, and a lot of people are going to put the nose to the grindstone and do some great stuff. And that's been true of every dislocation in history. Now, whether we've prepared, and I won't go too deeply into this, but the participation trophy problem is real, right? I've talked about it for years. Don't keep scoring soccer games because someone might lose. Bullshit. That's why you play games. Winning, losing, it's good. And it's been going around the internet, and I've been asking people. I actually asked Hubert Davis this. There was a dinner for the basketball program, and Stacey and I got to go because she's the super fan, and she made me get her a ticket. So okay, we went, and got to ask questions. I got to ask. So Hubert, do you love to win or hate to lose? And everyone needs to answer that question. Do you hate to lose or do you love to win? And you can't say both. You can't say both. You got to pick one. And that says a lot about your personality, and I think it's important. Winning and losing is important. And the idea that we're all the same and we're all equal and everybody kumbaya, And that Chinese engineer versus American engineer, China graduates 4.5 million STEM engineers every year. We graduate 500,000. So they start with 9 times as many. People say, oh, but they're not good. Fine. Let's say half of them aren't good. It's probably not true, but let's say half of them aren't good. That's still 5 times ours. So that just number, sheer number.
Crazy. That's a wild thing to say.
It's just that sheer number.
Yeah.
Goes to the focus, and they don't want to be a country that entertains themselves. They want to be a country of innovation, wealth creation, and they want to be the superpower, not a superpower. They want to be the superpower, not military domination, but domination of everything, technological, creation, manufacturing. It's a grand plan. And so, again, to finish positive, we do have the greatest innovation culture in the history of the world.
Yeah.
Full stop, right?
100%.
So many great innovations have come out of Route 128 in Boston and Silicon Valley and Austin, Texas, and Seattle and New York, and there's all these pockets of innovation. We have the greatest research universities in the world. Now we got other problems with the university system that we don't talk about, but research universities, awesome. And at the end of the day, we have capital that could, if we did it right, support those. And I'll get on my soapbox for 1 second. I still believe for young people, it should be against the law to own bonds in your 401k. You should be forced, and I do mean forced, coerced, to own venture capital. Not prohibited from owning venture capital, which is the current rule, but you should be coerced to put that capital in a place where entrepreneurs and innovators can use it and have access to it for super cheap. And then we'd have more innovation.
I was reminded again, I went out with, so I moved into this new building, and my girlfriend and I went out with there's a couple that lives below us. And I was telling them about, I never say crypto when I talk about my work because I don't want to get into a discussion about it, but they asked and I was like, oh, it's a crypto company. And Like, well, how much of your net worth, do you have in crypto? It's a high percentage. It's a high, and the looks that I get,
Don't want to talk about it.
It's like, you know what it is though? It's actually as if you're talking to someone who like got kicked in the head by a horse, and you're like deeply concerned about their health and future. It's like that. It's like, there's like a shock. Are you okay?
No.
And this happened to me again. I had a 10-year high school reunion, and I was talking to someone about this same reaction. And it was, I was like, well, what about you? I mean, where's she was entirely in bonds. This is a person my age. Her financial advisor put her in bonds. So, it's all spectrum, and you have to do what makes you comfortable.
That is a crime.
Mm.
That I'm deadly serious. That is a criminal act, because that person did that to ensure their maximum payout, right? They're probably in annuities and GICs would make it even worse. You put it in a GIC, a guaranteed investment contract, you get paid 3% guaranteed, quote unquote, and they take 4% for themselves. I mean, the nonsense, look, the whole mutual fund industry and the 401k industry is a scam to transfer money from the fearful and uneducated in terms of investing prowess. I mean, think about it. Before 1986, all of your pension was managed by professionals. Companies were forced to create pension funds, give you a defined benefit, meaning you knew how much you were going to get when you retire, and they had to manage the money, and they had to hire professional teams and do it. And then these mutual fund companies passed a law, they paid a lot of money for it in 1986, to change it to defined contribution. And the companies loved it because they saved 30%, because they could fund 30% less in DC than DB. They could fire their DB teams, and you transfer the risk to the employee. And now we have this underfunded. The average person in their 401k has $50,000, or maybe it's $200. I think total assets $250,000, but to retire, insanity. And the idea that a young woman has at 30 years old or 30 something years old has money in bonds is criminal. That is a criminal injustice. I feel really strongly about this. I mean, really strongly.
I'm with you. All right, Mark, we got to wrap it there. This has been a really fun one. Best hour of my week. I'll see you here same time next week.
See you next week.